Okay, let's start with a problem that's going to kind of walk us through the first couple of steps of the accounting cycle here. First thing we're going to have to do is analyze transactions. And what you can see right now is that we have our transactions right here. I have some of them hidden. We'll get to those on the next couple of slides. So we have our transactions here. We're going to have to analyze what's going on. We have our general journal, which is right here. I have it somewhat covered up, but you can see the date column, the accounts column, posting reference, and debits and credits column. Now when we do our journal entries, it's important to note that our debits always have to equal our credits. So let's keep that in mind. Number one thing is that our debits always have to equal, our credits. If our debits don't equal our credits, we made a mistake. So when we're doing these transactions, we know we're going to need at least one debit and one credit. Sometimes we can have more debits or more credits. As long as our debits equal our credits, that's a quick indicator that everything looks okay. If they don't, we definitely did something wrong. So I've also posted up here for you our basic accounting equation, assets equal liabilities plus equity, remember our ALE. And then I've also broken down for you the breakdown for debits and credits. So remember, assets increase with a debit, hence the plus sign here. Assets increase with the debits. It should carry a debit normal balance. Liabilities, common stock, retained earnings, and revenues all increase with credits. They're on the other side of the accounting equation. The only difference here are dividends and expenses, which actually increase on the debit side like assets do. So that's important to keep in mind when we're analyzing these transactions. Okay, so let's start with this first one here. We paid rent expense, $1,600. So we know we need at least a debit and a credit, and it's pretty easy to see something's going to happen to rent expense. So if we're paying that, our expenses are going up. Well, if I'm going to increase my expenses, I need to debit my expenses. So I'm going to go ahead and move this down, hopefully. Oops, wrong one. There we go. So you can see here that our rent expense has been debited for $1,600. That had the effect of actually increasing our rent expense. And cash is credited for $1,600. Anytime we pay our expenses, cash is going to go down. And let's see here, cash is an asset. If I want to decrease my assets, I need to credit that. So that has, again, the effect of decreasing my asset cash. So my expenses are going up, which is decreasing my equity, and my cash is going down. Now, in all cases, will we not have something going up and something going down? Let's do some more of these. Okay, on the 4th, we performed service for a customer and received cash of $900. So if we perform service and receive cash, okay, well this is good. We know we got cash, $900. We said just a second ago, cash is an asset. My asset cash is going to go up anytime we bring money into the business or into our personal lives. That asset goes up. So cash is going to increase. And then we performed a service. We performed a service here. Sorry. And that's how companies earn their money, by performing services or delivering product. That's revenue. And look at here, how do we increase revenue with a credit? So my debit is going to be to cash for $900. And my credit is going to be to service revenue for $900. And then let's again write what that effect that's having. A debit to cash, which is an asset, will increase my cash account. And a credit to revenue, which will increase my equity and my revenue, will both be going up for $900. All right, let's look at the next one. It says purchase supplies on account $225. Okay, well, we purchase supplies. So let's think about that. What kind of account are supplies? Assets, liabilities, or equity? Well, it's an asset. It's something we own. And if I'm buying supplies, bringing them into the business, that means my asset, supplies, is going to go up. So I need to debit my asset supplies. And I didn't pay cash this time. I bought it on account. It means I'm going to have to pay for it later. It's like using your credit card. And we call that accounts payable, which is a liability. So to increase my liabilities accounts payable, I'm going to have to credit that. And there we go. Ooh, doesn't want to go away. All right, so my supplies go up, which is an asset. Accounts payable, which is a liability, is also going up. All right, let's move to a clear slide and we'll start over and we'll do the next three. Okay, on the 11th, we purchased cash from credit customers on account. We received cash from credit customers on account. So customers that we have previously billed are now paying us. Anytime we receive cash, we get to debit our asset, cash, because that's going to increase that asset. And then from customers on account. So we had previously billed these customers. When we bill our customers, we call that accounts receivable, and we would debit our accounts receivable at the time. So in order to remove that balance on their account, we're going to have to credit the customer's account, which you may have heard people say that before. So we'll go ahead and move that down. So we will debit cash, which has the effect of increasing our cash account, which is an asset. And we're going to credit our accounts receivable, which is also an asset, but that will decrease that balance. So that's good. Let's look at the 15th. We sold an additional $5,000 of common stock. Okay, so we raised some more money by issuing stock. Again, we're going to receive $5,000. This is just like the last problem that we were working on. Anytime we receive cash, we know we're going to have to debit our cash account. And then let's take a quick look at what happens to common stock here. My common stock is going to go up because I'm issuing more of it. In order to increase my common stock, I need to credit it. So let's go ahead and debit our cash, credit our common stock. Cash will go up by $5,000 with that debit. And common stock will also go up with a credit. Remember, credits increase common stock, which is part of our equity. And then on the 19th, we paid $375 on account. Anytime we make a payment, we know cash is going away, and cash is an asset. So in order to decrease my assets, I need to credit them. So I'm going to credit cash, I know that. And then that was for a payment on account. So remember up here when we purchased supplies on account, now we're going to make a payment on that, which we said was a liability. In order to reduce my liabilities, I need to debit them. So let's go ahead and debit accounts payable, $375, and we'll credit cash. Accounts payable is going to go down. Our liabilities, we're paying them off. That's a good thing. My cash goes down at the same time, though. Cash is an asset. All right, next one. Last two, performed service for customers on account for $1,640 on the 27th. Perform service for customers on account. So we performed a service. We've done something similar here before. We performed a service and we're going to bill our customers. They're not going to pay us right away. So once we perform a service, that will be revenue. In order to increase our revenue, I'm going to need to credit my revenue account, and then I'm going to send them a bill. They're not going to pay me cash. I'm going to have to send them a bill, which is going to be accounts receivable. So I'm going to debit my accounts receivable, credit my service revenue here for $1,640. Means my revenue is going to go up $1,640, and my receivables, my assets, are also going to go up $1,640. Last one, on the 28th, we made a payment on the notes payable. Okay, anytime we make a payment, remember, cash is going to go down. Your checking account goes down every time you write a check. That is an asset. Cash is an asset. In order to reduce that, I need to credit my asset, so my cash will be credited, and we made a payment on our liability notes payable, $2,500. I need to reduce that liability, so I'm going to debit it. So notes payable is going to go down, cash will go down. Okay, so that's the journal entries that we have for that particular business here. And I've gone ahead and I've posted a nice clean copy of those journal entries. And the next step in the accounting cycle then is going to be to post those into the ledger. So this blue area is what a ledger would look like. These are basic T accounts. This is a really simplified way of what a ledger would look like. And remember, the left side here is going to be our debit side. The right side is going to be the credit side. Debit and credit only means left and right. Now, depending on what type of account, a debit will increase or a credit will decrease. So, for example, remember cash, which is an asset, increases on the debit side, decreases on the credit side. But if we look next door here to accounts payable, which is a liability, liabilities increase on the credit side, decrease on the debit side. Now they've already gone ahead and put in the balances here for us, and you can see those posted as of December 1st, and those are all on the normal balance side. So these are the sides that these accounts should carry balances. If you see balances on the other side, sometimes you may have made a mistake. For example, it would be pretty difficult to have negative buildings. I don't think that's really possible. So if you see a credit in a building, that's a problem. Now you may run a credit in your cash account, which is the negative balance. We're not supposed to do that though. Okay, so let's turn to the next slide, and we're going to go ahead and see if we can journalize those post those transactions from the journal. All right, I'll do my best here to write these in, or I may just have to do a couple and then flip to the answers. But when we're taking our journal entries, which is what we have here, these are our journal entries, and we're going to basically copy them into each of the individual ledger accounts. So let's start with the first one. Again, I'm just recopying. I did all the hard work earlier. I already know what's a debit, what's a credit, what's accounts. I just need to find those accounts and copy them over. So rent expense is debited for $1,600 on the second. So way down here at the bottom, I'm going to write in the second, and that was $1,600. Oops. Hard to get a really fine line. Okay, so I just recopied that over. That's good. And then you would write the posting reference. So this particular account should have an account number, let's say, I don't know, 50. And that's what you would write in the posting reference column once you actually posted it. Cash is credited for $1,600. So that would be on the second, $1,600 credit. And again, you'll have to forgive that things aren't perfect, but you can kind of get the idea there. All right, and then you would write in this account number as well. We don't know what those are. They're not given to us, so I won't do any more of those. On the 4th, cash was debited for $900. So we'll come over here. We'll just find the cash ledger account. We'll write in the date and the amount as either a debit or credit. In this case, it's a debit for $900. Service revenue gets credited for $900. So that will be on the 4th, $900 credit. So it gets a little tedious here. We'll do one more. Supplies has a debit of $225. So I'll come over here to the debit side of supplies and write in $225. That will be on the 8th. And then I need my credit, which is accounts payable. Accounts payable account is right up here in the top. And that's a credit for $225. So again, we're just copying exactly what we've already done from the journal into the ledger. Let's skip to the next page, which is a little cleaner, I think. All right, so here we have our completed ledger. I've copied all of my journal entries into my ledger. And you can see them all listed here, and then I've calculated a balance. And the way you calculate a balance is you add up all of the debits, add up all of the credits, and you subtract the debits from the credits. Whichever side carries a larger balance will end up carrying the balance. So the debits will offset the credits. Let's see. This is a pretty straightforward example here. I had a balance of $17,500 credit in my notes payable, and remember we made a payment. So my new balance is now $15,000. Take the credit, which is the larger, minus the smaller, $2,500 gives me a new balance. And we do that for all of our individual accounts. Then the last step in this process that we're going to discuss right now is to prepare our trial balance. And it's quite easy to prepare your trial balance. Again, we're really just recopying. We're going to take all of our accounts that have balances, and all of these accounts seem to have a balance. So we would list them all out. So I would see cash here. I'm just going to write cash down, and then I'm going to copy the balance. What kind of balance does cash has? Well, it has a $7,250 debit balance. So I'm going to copy that down into my trial balance. We would do the same thing for accounts receivable. We will write the account title, accounts receivable, and then I will take that balance, $2,340, and I'm going to copy it. It was a debit. I'll copy it into the credit column. Supplies has a $675 debit balance. Office furniture, $3,100. Buildings was $42,000. We'll carry that over. Okay, so accounts payable carries a credit balance of $725. So again, I'm going to take that balance and I'm going to copy it into my trial balance. The trial balance will be pretty much blank except for the account title, debit, and credit. So you'll have to copy in all of the account titles from your ledger along with the appropriate debit and credit columns. And then the very last step in our trial balance here, it looks like it's cut off maybe a little bit, is to total up my debit and credit columns. These two columns have to equal when we get done. If my debits and credits column don't equal when we get done, then we made a mistake and we need to go back and try and figure that out. So again, I'm just going to add up my debit column here, add up my credit column, and when we're all said and done, those two need to equal. If they don't, we made a mistake and we need to go back and figure that out. Thank you.